Hey, Emmett Dempsey, Treasure Coast Mortgage. Today we're talking about how the appraisal process works and how it affects you and your mortgage. So what's an appraisal bottom line? The appraisal is an opinion of value based on recent sales of like-kind homes. I want to make sure you don't confuse it with an inspection. The inspection is generally not required by us as a mortgage broker or lender. It is your inspection report in order to determine how well the systems in your home work, such as the AAC, the roof, what are the general repair and condition of all those systems in order to determine what needs to be repaired. So that's the inspection. The appraisal, again, is an opinion of value. Now, the appraisal is ordered through what's called the appraisal management companies, because after 2010, there's a rule called the Home Valuation Code of Conduct, because back before 2010, I used to be able to call up an appraiser and hire them directly, but ever since 2010, they put in a firewall of an appraisal management company. The appraisal is paid for by the buyer up front. It's one of your few out-of-pocket fees that you pay before closing. You can put that on a credit card. It costs anywhere from about $500 to sometimes over $1,000, depending on the size of the house, or if you're buying a rental property, you might need an addendum, like a rental comparable addendum. So anywhere from $500 to $1,000 is what it will cost you. So it goes into an appraisal. It's generally broken into two phases. It's the field work and the desktop work. Now, the field work, self-explanatory, is them going to the property physically. They take pictures of the inside and out. They also take pictures of the comparable sales. We'll get to talk about comps in a minute, of what he's comparing your house to. And they don't spend a lot of time there at the property. I know I've had some sellers and some buyers comment like, man, he was just in and out. Like, that's the shortest piece. It's just snapping pictures. They verify certain measurements against public records. If there's any discrepancies. But for the most part, it's very fast, in and out, done, snap a few pictures, and then he goes to do the desk work. Okay, the desktop work is the meat and potatoes of the appraisal. So what they'll do is they use a sales comparison approach. So you might have heard the term comp or comparable sale, and that's generally something that is sold, ideally within a mile. Okay, so distance is very important, as well as recency. So generally within the last 6 months, ideally in the last month or two, the closer the better, and the tighter to your home the better. Okay, so that's what a comparable sales is. So what they'll do is they'll pick about 4 to 5 comparable sales for their report, and they'll pick the top 3 out of those 5 or 6. Okay, so it's the top 3 that'll actually determine your value. So what they'll use also what are called adjustments. So no two homes are exactly the same. They do their best to match similar age, style, amenities. The 2-car garage, 1-car garage, similar lots. They do their best to find the like with like. So that's how they can determine what the market would pay for your house. So what they do is they'll do adjustments. For instance, if your house has a bigger lot, they'll give you a positive adjustment. If it has a smaller lot, they give a negative adjustment. And then the cumulative effect of those adjustments of the top 3, they start at the top, plus or minus all the adjustments, equals the bottom line. And then we'll do what's called a weighted average. So if one of those comps are exactly like your house, they're going to give that more weight. So it's not always a third, a third, a third. Sometimes they can add a little bit more than a third and a little bit less than a third, depending on the weight of that particular comp. Okay, so what does an appraiser look for generally in their field work? A few things. Number one is the exterior. They say there's any holes in the exterior, any wood rot, things like that. Again, it has to be blatant. Like I said, they're not going through it with a fine-tooth comb and with a magnifying glass and making sure and see what's out there. But it's just a glancing below the exterior. They'll walk the exterior, measure to make sure, again, much as public records. The health and safety is very important. For instance, if the kitchen's not done, or if you have standing water, and again, blatant things. Running water not done. On certain government loans, they'll do water testing. If it's a well water, they'll test the water, and they'll require that to make sure the water's running. It's not obviously dirty. Again, blatant things to make sure all major systems for health and safety matters. Again, like I said, to verify the size of the bedrooms, count the number of bedrooms. It happens sometimes where that prior owner might have added a bedroom and didn't permit it properly, and so that's the case. You have to address that so that they match it to the public records. And just a general interior condition. It's important to see, if it's clean, the walls are all intact. Also, any improvements that have done with the property. So if you've done a renovation, so they'll value the improvements. They'll give a quality rating to the condition of the house, especially if you have an older home on paper that might have been built in the 70s or 80s, but yet it's been fully updated. Make sure that the appraiser knows everything that was done. And that's where your agents come in about them being there at the appraisal to help give them that information, as well as the amenities of that property. Say, for instance, if there's a community pool, if the house itself has a pool, and what amenities are available. Again, trying to match like with like, all similar pluses and minuses, pools, amenities of versus comparable sales versus the property that you're buying or refinancing. Okay, so what is the appraisal timeline? The first step is, of course, the disclosures. Now, when you select a loan, you send loan disclosures. First and foremost is the loan estimate and the intent to proceed. And I talked about that in the loan estimate video here. You can check that out. So once you sign your loan estimate and your intent to proceed, then we're able to order the appraisal and charge fees for the loan. And at that time, we order the appraisal through the appraisal management company, as we talked about earlier. And that appraisal management company basically puts out the call to all their panel of appraisers in that area, say, hey, appraisal order placed, who can take it? And depending on how busy those appraisers are, and right now they are pretty busy, it can take a day or two before that appraisal is assigned. So once it's assigned to an appraiser, that appraiser will then coordinate whoever the contact is. It's usually the listing agent or the buyer's agent or the homeowner on a refinance, and they coordinate that time to schedule the inspection. Okay? So what they do is, and then the inspection takes place. They come out just as I talked about. That's usually very short. They come in, take pictures, measurements, talk to the agent about any of the upgrades and whatnot. So that's why it helps you. Usually both agents go to that for you in order to do that, unless you're the homeowner or refinance. And then you just talk about some of the things that you've done to the property. So the field work is done. The appraiser goes back and does the comparable sales approach, like I talked about, does his research, and then after that, a couple days later, I'll get the report. So we'll get the report, we'll evaluate it against the contract price or the refinance price. So that value belongs to the buyer. Okay, on a purchase, you don't have to share that with the seller. A lot of times the seller doesn't know what it came in at. The listing agent, asked for it, but that appraisal belongs to you, the buyer, belongs to the buy side. For me, I give it to the buyer, and if he or she chooses to share it with the other side, that's your prerogative. But my recommendation is you keep that value to yourself, and then the agents can talk that out. Okay. So you'll get the report, and then we'll reevaluate against the loan terms that we talked about. Now, there's generally going to be three things that happen once it comes in. Either the value is at the contract price, okay, which is cool, and you can move forward as planned. It comes in higher, great, you get a little bit of equity, or it comes in short. An appraisal gap, as I call it. Okay, so how do we deal with appraisal gaps? There's a few different ways. In the past, there's really only three ways for that to happen too. Either the seller drops their price to match the appraised value, which has happened, or you split the difference. Okay, so kind of you pay a little bit extra to do that, or you just pay the agreed upon sales price, which in this market these days has been happening more and more. And there are a few ways that we can address those. The appraisal gaps, I'm going to cover that in another video. But generally, you have to have the cash. If you're putting more money down, it doesn't affect you as much. If you're putting down minimum 0% down, you have to have the money in order to meet that appraisal gap. And there's also certain ways like the mortgage insurance that we can do that. And I'm going to talk about that more in detail in another video. Okay, so what are some of the results of the appraisal? So there's really only three things that can happen. Either the value comes in at contract price, okay, and then you're good, we just move along. Or the value comes in higher, which is great for you, so you get a little bit of equity above the sales price. Or the appraisal comes in short. Okay, so that's been happening more and more, especially in this market we're in 2021, where buyers are overpaying even above the market. So there's three ways we can resolve that as well. So if it comes in short, either the seller matches the appraised value, which has happened and doesn't happen as often as it did before, or the buyer and seller can split it, and the agents work that out, or you as the buyer just come up with the money to meet that sales price. So you're putting more money down. Obviously, it really doesn't affect your loan as much because depending on how much you're putting down, it might change your pricing a little bit as far as your points and rate just a tiny bit, or you have to add mortgage insurance. But usually the general cash out of pocket usually won't change if you're putting more money down. I would just usually add mortgage insurance. But if you're putting less down, it could really affect your ability to buy that house unless you have other cash reserves in order to meet that appraisal gap. So there's a few ways we can address that, either through mortgage insurance, through lender paid insurance that the seller pays for, a couple different ways. And I'm going to do a video on that in detail for appraisal gaps. But that's generally the three ways that we handle appraisal values. Okay, so that was how the appraisal process works. Hope you found that informative. Here's some more videos on my channel you might find useful. And again, if you want your own mortgage consultation, go to DempseyMortgage.com and give me a call. Thank you so much for watching, and I'll see you on the next one.